defines best practices in treasury management? Is it technology? Is it your view of the world? Is it a system of checks and controls? Welcome to CurrencyCast. My name is Agustin McKinley. I'm the senior financial writer at Cantox and your host. In this episode, we have the pleasure to welcome Royston Da Costa, Assistant Treasurer at Ferguson PLC. Royston Da Costa, a very warm welcome to you, and thank you for joining us in this episode of CurrencyCast.
Thank you, Agustin. It's my pleasure. I'm looking forward to this discussion.
All right, Royston, can you please introduce yourself to our audience?
Of course. So, as Agustin mentioned, I work for Ferguson PLC. We are a North American leading value-added distributor of plumbing and heating products. Just under $30 billion is our turnover, and we're primarily listed on the New York Stock Exchange. My current responsibilities are looking after the UK company loans and driving the treasury technology for our group, as well as supporting our treasury operations and the more strategic transactions when they happen. I've been in treasury for just coming up to 36 years, although I've been with Ferguson for 22 years in various roles in treasury. My previous experience has been with companies like Sky, Gillette, Vivendi, Universal, Polygram, and Seagram. Currently, we look after 13 cloud-based solutions, including Coupa, which is our main treasury TMS, and we use Oracle for our ERP solution.
All right, that's really interesting. Now, you define yourself as an advocate of best practices in treasury management at Ferguson, and that begs the obvious question: how do you define best practices in treasury management in 2024?
Great question, Agustin. I mean, look, I suspect that, there are a lot more other companies that would probably have a lot better terms of technology and process than we do at Ferguson. But I think in terms of what we set out to achieve and in terms of what we have achieved, I would suggest these are the four pillars that I've kind of held to whenever we considered a new system or technology, and I still do when we look at any new solutions. And they're very simply this. Number one, visibility. Well, that sounds like an odd one to start with, but actually it was very appropriate for when we looked at our cash visibility. And clearly that's a very big topic for a lot of companies today, in fact. But for me, visibility doesn't just apply to cash. It applies to everything that we do in treasury within our group. And so the idea behind that is to make sure that whatever systems we have in place, whatever technology we have in place, is giving us full transparency of, for example, trade finance or letters of credit, any FX deals, bank accounts obviously come into it. Basically whatever treasury is responsible for, we at the group function need to have that visibility, and whatever technology that's in place gives us that visibility. So I can say, for example, that we have 100% visibility of all of our bank accounts around the group.
Right.
And that's a good starting point. Secondly, I'll say connectivity. And again, it's an obvious one, but it's bizarre or quite surprising how sometimes when you look at new technologies, they don't always, they're not as easy to implement or necessarily give you that benefit. So it's very important for us, and this is why cloud-based solutions are so much part of our infrastructure. We like the concept of plug and play. And so when we're looking at new technologies or new solutions, they have to be very simple and easy to implement and connect with our existing infrastructure. And we could talk about this later on. I mean, I think APIs have probably a huge part to play in that going forward. Security, absolutely, without question. Every treasurer's nightmare, if you like, in terms of the world we're living in today. It has to be beyond reproach. And when I say that, I mean not only just in terms of the so when you look at it and you think, well, is it robust, is it secure? It has to meet our internal IT criteria, and it is very stringent, I have to say, but not unreasonable. And the last one, again, another obvious one, efficiencies. Any technology that you implement today, I feel, would automatically, in my mind, should yield efficiencies. Sometimes it's very difficult to quantify those efficiencies in terms of financial benefits. But I would say that if that's not always possible, at the very least, they should offer you time savings. And I think we've managed to do all four of those points. Achieve all four of those points in terms of our infrastructure that we have today.
Right, really interesting, and it goes exactly in the direction that we also favor so far, and they are connected. Some of them, right? You have visibility because also you have good connectivity, and you have good connectivity because you have, of course, your API based connectivity that leads to efficiency. So all of them are connected. Now, Royston, what about the place of FX management? And I say FX management beyond maybe FX risk management in terms of best practices in treasury management.
Again, great question. There's no, it's fairly obvious for most treasurers and treasury functions that FX risk management is a key part of their responsibilities. And certainly within Ferguson, it's been no different. Admittedly, we're not, in terms of my experience, in terms of companies I work for, we don't handle a huge amount of FX for the simple reason that we are a decentralized business. And that means that we have, and we do effectively supply our customers domestically, and we source that product domestically. Right. So there's very little cross-border exposures for us. I mean, we do face some exposures in terms of, for example, dividends that we pay to our shareholders that still require sterling dividend, but that's obviously only infrequently. On an operational basis, we have limited exposures, it's restricted mainly to our subsidiaries. Having said that, I kind of thought about, in terms of my past experience, and it's interesting how, because I've been in treasury for the time I have, there was a time when you had to deal exposures using a telephone. And the most you could do in terms of the number of banks you could invite to bid on a deal would be 2 banks, purely because depending on the size of the team, but generally that was the kind of the kind of approach. And today you've got, obviously with the technology we have, online trading tools, systems, and in terms of our infrastructure, we've got that process pretty much automated, apart from the actual deal itself that someone needs to execute themselves. But once that deal is executed, it all goes through our systems very automatically, and there's very little manual intervention after that. And in terms of what I'm aware of, again, it's not necessarily something we do at Ferguson. The technology today and the sophistication of some of the processes around risk management, like, for example, algorithms that not only the banks use, but even corporates are using now, where if, for example, I go back to when I worked at Seagram's and we had a huge hedging program, over $10 billion worth of hedging that we used to do per annum. This was all conducted on spreadsheets in those days. Now, right. Not knocking spreadsheets, I'm sure we use spreadsheets today. But my point being is that, like, corporates are sort of evolving that process and using much more sophisticated tools and mechanisms in how they're kind of looking
Absolutely. After indeed, and we've seen the cases of large companies having in place very sophisticated FX hedging policies, but they were conducted on huge spreadsheets, creating both spreadsheet risk and key person risk and all sorts of problems there. So let's discuss now the topic of automation and control. And I'm going to say the obvious here. Business process automation is one of the defining ideas of our time, right? And at Cantos, we like to say that we are, maybe the leaders in what we call currency management automation. Yet, we are keen to emphasize to prospects, to customers, that automation always comes with enhanced visibility and control. All right, let's now change the topic a little bit to the subject of automation and control. And I'm going to start with the obvious here. Business process automation is one of the defining features of our age. Now, when it comes to currency management automation, we're keen to emphasize to prospects and to clients the fact that automation always comes with enhanced visibility and control. So to give you just an example, we like to say that in all our automated solutions, there is a feature that we call end-to-end traceability, meaning that along the transaction journey, each element has its own individual reference number. What I want to say with this is that far from weakening control, automation can lead to more efficient and even enhanced control. And that leads me to the question, Royston, do you see the perception out there in the Treasury world that there is a fear of automating business processes, in particular in Treasury operations, leading to less control, which of course we don't agree with, but what is your view on that?
That's a great question again. I do have some sympathy with that view, and I'll explain why. Let me start with, we started our automation journey back in 2010, post-economic crisis, and new senior management and the new CFO basically looked at our infrastructure and thought, you've got some systems here, but they're not joined up. There's very little automation, very manual. And so he saw the wisdom, if you like, or the benefit of having automation. So I think when you approach this subject of automation with treasurers, it might sound a bit obvious, but we need to think about what process we're looking at.
Right.
If it's like we did initially, market data, it's low sensitivity, low risk potentially. You're ingesting market data coming in. That's an easy process to automate and shouldn't really be a huge issue for most treasury functions or treasurers. When you look at FX, which is the other, in a sense, end of the spectrum, or even payments, there's a lot more risk for sure. And when treasurers, I think, approach this subject of automation, including myself, we are going to be naturally risk averse. We are going to be naturally cautious, conservative. And I've always maintained that, technology is I'm a big fan of it, as I think most people are. But we should always also be very careful in terms of making sure that the underlying process that's being used is clear, transparent, and fully understood. Right. Now, for someone like myself who I'm not saying that, therefore I just go into anything without thinking about it, but I'm more familiar with some of these processes. They might have mentioned APIs earlier on, but I would still, if I were looking to implement something new, would want to understand the end-to-end process. In the same breath, I'm also aware of what you've said about some of the benefits of that automation, but more importantly, in a sense, for me, is the endorsement, the support from our auditors and compliance and regulators. So when in our company we're subject to Sarbanes-Oxley, and it's not really surprising, but it's interesting how very keen they are on, wherever possible, having an automated report, and if that report's a PDF report, even better. So I kind of put that out there just basically to see, in terms of one of the clear benefits that you get from automation is, at the very least, sort of a tick from the auditors, and which treasurer wouldn't want to have that. But let's get back to your core question, which I think is still important and I want to address. So depending on the process, now we look at FX. I think for me, I would say, let's look at what we can automate that we're comfortable with. So when it's to do with, say, the data that, and we don't have this particular process as such in Ferguson, but of what I'm aware of, and in my previous job, I'd want that to be automated potentially. But I'd still want some sort of balance and check at pivotal points. In other words, if someone suggests to me, okay, your subsidiaries are sending you this data, and we can offer you a process that will automate that process all the way from the subsidiary sending the data to the deal being executed in the market. No manual intervention at all. I wouldn't be comfortable with that. Now, I'm not saying that might not work, and it probably does work for some corporates, but I would still want some sort of intervention at least once, if not twice, in that process, just to be sure. I think the other point to bear in mind also in terms of those balancing checks, they could also potentially have controls using technology where you say, okay, instead of a manual check, let's put a limit in place. So that would also be a way of how you kind of avoid potential disaster scenario occurring where, let's say the proverbial $2 billion goes out into the market to get traded by mistake, too many zeros, that sort of thing. But I'm definitely
the fat finger mistake, right?
Yeah, I'm still a big fan of where possible and wherever practical, and obviously Treasury policy plays a big part in this. We want to make sure we're compliant within that. Absolutely, automation is the key. And as I said, again, just to repeat the point, you will get that validation from the auditors, which I think is a big plus.
Right. And from our experience, we know that auditors really like that feature of perfect traceability, right? You can track each element along the transaction journey, so to the underlying exposure, and that's very, very useful in terms of working with auditors.
Great. And one other point to add to that, and I think you have to split that process again in the sense that what goes out to the market clearly is going to be more sensitive. So that process that happens before the trade's done is a bit more critical than after the trade's been done. I mean, clearly the whole process is critical, but I'm thinking of the point about more automation. Once the trade's been done, I see no problem and no reason why anyone would not want all of that process to be automated, because frankly, there's not much value being added after that point by someone manually intervening. Once the trade's done, it's done. I mean, if it's wrong, then obviously someone needs to check, but automation will help ensure that check happens a lot more quickly, like we do currently. For argument's sake, the deal's done, it goes into our TMS, goes up to Finastra for confirmation, and then a report is generated for someone to check to make sure the deal's matched. All of that sort of process, you do need automation, because the more quickly that's done, or speedily that's done, the more likely if there's an issue, an error or a mismatch being picked up, you're going to benefit from that.
Right. I find this is really interesting, because if I understand you correctly, you would be putting the more emphasis on controls rather at the pre-trade phase of the FX workflow than at the trade and the post-trade phase. And it's really, really interesting. And we fully agree with that, as there are in the process of currency management automation, lots of manual checkpoints, especially in the phase of exposure collection and exposure processing, because there could be critical errors that need to be avoided. Absolutely. So in agreement with that. Royston, I was reading a research paper yesterday on the link between the quality of internal controls and the quality of reporting in general, and even beyond that, making a link with the quality of corporate governance and perhaps even the cost of capital. I know it's a very broad issue, but it goes along the lines of your thinking, right? The importance of internal controls, checks and balances, leading to perhaps a lower cost of capital. Is that correct?
Yeah, I mean, the issue I think I had when I looked at building a business case for implementing some of the technology we have today, it wasn't immediately clear what the financial benefits would be, and that within Treasury is it's a no really, frankly, and for any department, frankly, when you're looking to go to your CFO to present a business case for a new technology or new project, you need to ideally confirm or quantify what the financial benefits are going to be. But what I found actually that we were able to do, I wouldn't say more easily, but more transparently, is quantify the time savings initially. And in fact, today and many of my presentations, I quote a number of 104 days per year over time, and over the, overall for the technology we've implemented. I will put this out there as well, because I know sometimes the obvious question is, if you save so much all that time, then why is it that you didn't lose team members or staff? And this is what I say as well with Treasury. We've always been very lean and mean. Most Treasury functions are very small teams. The way to look at it is this way: technology effectively helps you to future-proof your Treasury function, I think. Right. In other words, let's hope that we all want our companies to grow, as ours has done. And so in terms of the technology we have, whereas perhaps in the past we'd have had to increase our team to accommodate some of the extra, the expansion that we've experienced, the technologies help to mitigate that. But nevertheless, I'll still maintain that in terms of the benefits we've seen from technology, time savings I mentioned, there have been obviously some cost savings as well over what we would do. For argument's sake, with a lot of cloud-based solutions, we didn't have the amount of IT support that we needed with our hosted solution in the past, and upgrades and so on and so forth. There are a lot less, maintenance in that respect. But I think coming back to today's world, need I mention that I think we've done really well so far for not bringing in the P word, the pandemic. I think a lot of companies recognized, unfortunately, that they needed cloud-based solutions once the pandemic struck, because in order to enable their teams to work remotely, as we did at Ferguson, or were able to do it at Ferguson, technology is a big part of that. So there are, so many benefits that are not necessarily quantifiable from a financial perspective, but clearly in this day and age, they are, I would say, the basic standard that most companies have to incorporate if they want to be able to kind of ensure going forwards that their teams can continue BAU if, God forbid, another pandemic or another crisis were to occur.
Right. Okay. Now, at the beginning of this conversation, I said, hey, Royston Da Costa here, who's going to discuss best practices in treasury management. And I asked the question, is it about technology? We discussed that a little bit. Is it about controls? We discussed that extensively, but there's also perhaps a broad view of the world. And I would like to go in that direction, if you don't mind, Royston, starting with what we discussed perhaps in private about central bank digital currencies, or CBDCs. I remember teaching a course in finance here in Barcelona 2 years ago, and I presented the e-krona project, the project of the Riksbank, the Central Bank of Sweden, about the digital krona. And the student was so enthusiastic about it that he immediately asked me if he could write about it. But I sense, correct me if I'm wrong, that there's a little bit less enthusiasm going on right now. We're going to have specific questions, but first, what is your overall view about the development of central bank digital currencies? Do you think is going to go ahead?
It's not really for me to say whether it's going to go ahead, in terms of there are 11 countries that have already implemented CBDCs globally, and there are another 53 countries, including the UK, China, and some of the other world economies, the US, that are in the advanced planning stages. So, and another 46 researching CBDCs. So I think that alone says to me, it's happening. It's happened and it's happening. I think it's interesting that CBDCs, and if we include that term, which is central bank digital currencies, in the wider scope of how that's discussed, cryptocurrency comes into play or into that discussion. And wider still, if you look at that under the umbrella of technology, the same theme keeps reoccurring, which is treasurers extremely skeptical about all of this. And you mentioned the word fear. I think that has a big part to play with it. And I think there's no shame in saying that, for the simple reason that that's how we've been brought up in Treasury, we have been brought up to be naturally cautious, naturally conservative. I mean, fear is probably not the right word to use in that respect, but nevertheless, to approach everything with caution.
Right, with prudence, right?
With prudence as well. Now, where I kind of draw the line is to say that's absolutely correct. That's how we should operate. But how do you then deal with this area of technology, CBDCs, and what we're looking at today? Because this is the tip of the I don't use the word iceberg because it's not, because it's wrong connotations, but icing of the cake in my view, frankly, because there's so many other technologies out there that I know of, which I think will have a huge impact on Treasury, like digital twins. But let me talk about CBDCs. I think this is a very important area. So
yes, I know that you're an advocate of the idea that it could bring better payments, more transparent payments, faster payments. Is that right?
I agree, absolutely. And there are banks that are already offering a form of digital currency. For example, JP Morgan have their own payment rail called Onyx. And I believe even HSBC are bringing out something like tokenized deposits. Now, admittedly, both these banks are only offering this within their own network. But when you look at CBDCs or digital currencies, and I think you have to now separate what I'm looking at or referring to from cryptocurrency, because I would not advocate, we don't use it in Ferguson, but I would not advocate using cryptocurrency as a norm because of the volatility. And as I said, most Treasury functions, as far as I'm aware, we are here to manage risk. And so this is not the kind of, having said that though, again, what I've been hearing is, and this is more about the cryptocurrency, where the challenge we've had around trapped cash in certain areas of the world, cryptocurrency is being used as a solution to get that cash out, which is very interesting to me and it looks very promising. But we'll come back to CBDCs, because my view there is it's to look at what's the value, what's the benefit that we'll get from digital currencies, and why are governments looking at this in such a strong way? Very simply, I think speed, they're cheaper to process, 24/7 in terms of validating, and it's transparent. It's very auditable. Digital currencies, CBDCs, not cryptocurrency.
Right.
And from a Treasury perspective, we are today still dealing with payments that take up to 48 hours, if not longer, to be paid end to end. Whereas you and I both know, this generation have grown up in an environment where most of them don't even have to open a bank account like we do or did. They can open it in 2 minutes on their phone, and they can process a payment within seconds, or we can process a payment within seconds. I'm thinking of today's generation. So this is why I'm saying, in terms of looking forward, there's the kind of accepting making payments the traditional way is going to be challenged more and more, because why should we have to wait 48 or 2 days for payment to be processed?
Absolutely, and that goes well with these ideas of both the ECB and the Fed speeding up their programs in terms of instant payments. That's really interesting, and it's going to have major consequences if all of this really goes ahead in terms of working capital management and liquidity management. Yes, I agree with that, absolutely. Royston, is there something that you would like to add there on the topic of CBDCs?
Yes, so one thing I want to talk about is looking ahead at what impact CBDCs will have on companies generally. So I'm not sure if you're aware, but Visa Direct recently announced that they are able to convert cryptocurrency to fiat currency. So again, that's another example where the world is evolving at this space where digital currencies are being offered by some of the wider market providers. But I think further to that, if you look at technologies like quantum computing and the accuracy of forecasting, cash flow forecasting, and managing exposures is increasing on a daily basis. What do I mean by that is I know of companies, and one in particular, that uses quantum computing to hedge commodity exposures to an 80% degree accuracy. Now that's quite a pretty impressive metric to look at. And I see that even with generally with companies where cash flow forecasting is quite a challenge to try and get that level of accuracy today. But as data becomes more widely or more available at using these technologies, and we can begin to hone in onto the sort of the differences, I think this is where, again, not just CBDCs, but the technology working together will help improve the work that we do in Treasury. What I would say as well is I don't see currency exposure disappearing because of digital currency. Simple reason, there's 180 currencies globally.
Right.
And you only need 2 currencies for FX to exist, really.
Absolutely.
2 major currencies. And we know that we've got obviously at least the dollar, and you've got UK sterling and Chinese yuan. But so my view, until someone invents the proverbial crystal ball, you will still need treasures, you will still need FX, and someone could manage, could be able to simply have the right skills to manage that risk and that exposure. And this is why, again, the technology comes into play, because if you stand back, I can see 2 kind of streams, if you like, going to converge at some point in time. But can I say for sure exposures will disappear? I don't think I can call that, and I don't think it'll happen certainly in my lifetime. But in terms of improving the way that we interact with banks, with fintechs, that process is definitely going to get much sharper, much more efficient. And I think in terms of even your product that you offer, I think you'll be interested to see how that's going to evolve. Thank you.
Right. Yes, absolutely. And I think our audience now has come to the conclusion that Royston Da Costa is indeed a man with a wide range of interests. And I really thank you a lot for that, Royston. I think we've been through several topics here. We started out with the best practices in treasury management. We discussed a little bit some technology issues there, and we went to the all-important point of controls, checks and controls, checks and balances along the process of the treasury process. And we then discussed central bank digital currencies, how to speed up and improve payments. It's been really a pleasure, Royston. And again, I want to thank you for that. And well, I hope you will have the opportunity to talk to you again soon. Royston Da Costa, Assistant Treasurer at Ferguson PLC. Thank you very much for joining us today on CurrencyCast.
Thank you, Agustin. It's been a very interesting and enjoyable conversation.